What is going on, traders? Welcome back to the Traveling Trader. Out here taking a break from my mental health. To be honest, I've been nonstop going for years, even recording while I was on vacation, but that's not your problem. In this video, I wanted to do sort of an emergency update because obviously the Fed meeting is going to be on March 16th, on Wednesday, March 16th at 2:30 p.m. Eastern time, I believe. And there are a couple of signs that I wanted to talk about, a couple of market signs to watch out for. Now, let's just get right to the point that I don't think the Fed is going to raise rates drastically, especially considering what is going on between Russia and Ukraine in that conflict, and the fact that that is worsening, the fact that oil prices as well as commodities are surging, even though they have retraced a bit, but they are still holding steady now, really awaiting the geopolitical outcome, really awaiting what the Fed is going to do, and awaiting the possibility of a recession. But hiking rates too high into an economic slowdown is really suicide. I know that the Fed really doesn't have a choice but to hike rates. I know that they wish that they probably could just keep them at zero, but the price of everything is surging. Jay Powell's probably going to come out and say that, prices have retraced a little bit and we expect them to continue to retrace, but they really don't have a solid track record when it comes to that. However, looking at the CME Fed Watch tool, it does look like even the Fed members are expecting 99.3% expecting a 25 to 50 basis point rate hike, not anything higher than that. Okay, now here are the points of concern for me. Looking at Apple and Microsoft's chart, and you might be thinking to yourself, why are we talking about two individual stocks? Well, because honestly, the S&P 500 as well as the other indices, we would be in a full-on bear market. The Nasdaq is in a bear market right now. However, the other two indices, the S&P and the Dow, are not in a bear market. But we would be in a full-on bear market if it wasn't for these two stocks, Microsoft and Apple, which have really upheld the stock market and the major indices, and they take up a lot of space in those indices. They are heavily weighted, but they both look like they are in a downtrend. Looking at the weekly chart, they've broken their long-term trend going all the way back to the Rona crash of March 2020. That is a 2-year trend. And looking at this now on the weekly, they both look the same. They both broke below the 50-week moving average, broke below the 2-year trend, and it looks like they're both heading for their respective at least 100-week moving averages. Now, these are usually buy points for these companies, so I'm not saying that avoid these companies. I do think there is a case to be made for dollar cost averaging soon. However, with these companies dropping to their 100-week moving averages means that more likely than not, the S&P 500 will continue dropping as well. And we will be on the precipice of a potential bear market in the S&P 500. The S&P 500 is also flashing what is called a death cross. Now, a death cross, it usually means we are actually closer to a market bottom. I know the name sounds ominous, but it usually means that we are closer to a market bottom than a market top. Only on a very few occasions, the 2008 financial crisis being one of them, did the death cross signify even further downside, and it was significant downside, right? There was that initial drop in 2008, and then once the death cross happened, another wave of downward momentum. Now, the one thing that I think is really the main thing to watch in terms of a sign that a potential recession is coming is the inverted yield curve. This is the difference between the 10-year and the 2-year bond. Right now, the difference is just 0.25%. If this goes to 0% or under, then this has always flashed a recession. Now, for those of you that don't understand, the 10-year and the 2-year, they are both types of treasuries, right? The 10-year is obviously the further one. The 2 years is the one that matures the nearest. And you expect the 10-year one to pay more than the 2-year one. That's in 99% of the time, that's how it is, right? However, an inverted yield curve means the 2-year one now pays more than the 10-year one. How does this happen? Well, it means that there is a bond sell-off in the 2-year because investors are terrified of what's to come in the short term. So they don't want to hold a 2-year bond because, say, for instance, they expect inflation to be just tearing through the economy in the near term. They sell off the 2-year. And what happens when bonds sell off? Rates go up. So the 2-year shoots up and sometimes overtakes the 10-year. When that has happened, that has always signified a recession. So keep an eye out for this. The 10-year and the 2-year, you will see the chart on the screen. Look up this ticker symbol in TradingView if you want to track it yourself. You can also Google 10-year, 2-year inverted yield curve, and you could see it on Yahoo or whatever link comes up on Google. One other thing, going back to Apple, and the reason why there could be more decline for Apple is because there have been 10 declines going back to 2009 of more than 15%. The average decline is 30.7%, while the median decline has been 29.4%. So when Apple declines by at least 15%, it continues to dive. And we see that in its technical pattern here, right? We will definitely be hedging Apple. We will be playing Apple using probably a combination of puts and short call spreads. If you want access to all of our hedges, we've been hedging since November. Those of you that are part of the Discord know this. But if you want access to all of our hedges, link is in the description below. It is vital that you learn to hedge in this type of market, because just buying stocks and trying to make money doing that in this market, you will get killed. However, knowing how to play options, to play both sides of the market, even if you hold Apple shares, making money off of an Apple downturn in order to recoup some of that money you lose from the shares, that is vital in this environment. To each their own. But if you want to learn how to hedge, again, we've been doing it really heavily since November. Come be a part of the group. Would love to have you. So in summary, the Fed likely won't raise rates more than the 25 basis point, could go maybe to 50 basis points, but won't go more than that, in my opinion. The Fed members agree. 99.3% of them think that is the case as well. That is unfortunate because prices are surging, but we cannot afford to raise significantly into an economic downturn. Look up the 10-year, 2-year inverted yield curve. If that gets to 0% or below, we are likely in for a recession. Obviously, keep a watch out for the geopolitical conundrum that's now taking place in Russia and Ukraine, with China being a potential third player in that. Take a look at Apple and Microsoft's weekly chart. See if we break below the 50-week moving average and get to that 100-week moving average. That will likely signify a further downturn in the S&P 500 and potentially get to a bear market there as well. We will continue to open our hedges, keep our hedges open, not only on the indices, but also on the major stocks. However, remember that a death cross usually signifies that we're closer to a bottom than a top. There are a lot of attractive stocks here for the long term. So don't just be all doom and gloom. Evaluate stocks that you've been looking to own for a long time. Look at the prices that they're at, whether the prices are attractive to you for your portfolio. I definitely will be sending out more long-term stock alerts as well on things that we're nibbling. Anyway, traders, leave a comment down below. Let me know what you think. Let me know what you think the prospects of a recession are, what you think the Fed will do. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.